Hello, everyone. Today, I'm joined by Dan Johanis from Pekoe Mortgages, where Dan is the founder and principal mortgage broker. Dan is also a real estate investor, and full disclosure, we've both invested in East Hills Crossing in Calgary, the same development. So there's been a lot of talk in the mortgage environment and space right now. The US Federal Reserve just raised their interest rates by 0.75%. This was actually the largest increase in almost 30 years. But with that increase, they only went from 1% to 1.27 or 1.75%. And they said another rate jump might be coming next month. The Bank of Canada has been on a similar path, raising rates, really over the last 3 months, have gone from 0.25% up to about 1.5%. So tracking very similar to the US, and a few extra increases are still to be expected. And it's all because we're battling inflation right now. We can do a whole other topic about what's causing that and what's going to happen there. But I brought Dan on today to talk about the fear in the mortgage marketplace that I'm seeing from a lot of my clients. It's constantly in their face, it's being hammered with it in the media. So Dan, what are you seeing in the mortgage marketplace right now?
Hey, Kyle, first off, thanks for having me on your episode here. I really appreciate you giving me the opportunity to talk to some of your clients too. And yeah, that's a great question. It's the number one thing that's coming up right now at our brokerage is, what are we seeing? What's going on? Is the sky falling? Is this something we really need to be concerned about? And I think what's happening is that one, media tends to sell headlines, right? And sensationalism definitely sells. So that's something you want to take into consideration anytime you're looking at what's going on with rates. You're right, though. The Feds definitely did bump up. I think it was the largest increase in something like 31 years, I think I read. So they've bumped up their rates. Typically what happens here north of the border is we follow suit. So we have, the Bank of Canada, the governor, Tiff McLaren, I think his name is, he's come out and he said, look, we're likely going to have to raise rates again. And we knew this wasn't something that kind of hit us out of the blue. It's been predicted essentially since we were kind of coming out of the recession, or sorry, not recession. We might be going in a recession, but that's a whole different topic. But coming out of our pandemic, right? So
yeah, and this should not be a surprise to anyone, really.
Yeah,
right.
Exactly. Yeah. So it was sort of to be expected. And what we're kind of facing is obviously rising interest rates with both fixed and variable rate mortgages. But when we kind of break it down into what this means, it's still overall, if we look at interest rates going back to the 80s or even the late 70s, we're still in a very low competitive interest rate market, right? It's just, I think the last couple of years we've been spoiled with having lower than typical rates. So
I think people forget that. We are still historically low when you look at the chart, since they started tracking interest rates.
Exactly, 100%. The interesting thing is that if we look back actually in 2009, so around September 2009, before the pandemic hit, our prime rate for variable rate mortgages was sitting at 3.95%. So it was actually higher. Like today we're 3.7. So we're lower than right before we hit the pandemic, right? And obviously we had monetary easing happening in the market. We had to kind of prop up the economy, and interest rates just tanked to help with that. Now, obviously, I think part of it too is that inflation has hit us pretty hard. So in order to kind of keep our inflationary rate on target, the Bank of Canada has stopped the monetary easing. Now they're doing tightening as of April, I think 22nd is when they announced it. And what that basically means is that they're making borrowing a little bit more expensive. And by doing so, they're trying to get inflation back in line. And yeah, they follow suit with the Fed. So we're likely going to see a few more rate increases on the horizon, both fixed and variable. So, but I don't think it's anything really to worry about. If we put it in dollar terms, right now, a 25 basis point increase on a variable rate mortgage, for every $100,000 you borrow, a 25 point increase works out to about $12, right? So it's fairly, I mean, you're going to have to maybe stop with the daily Tim run, or at least cut it down a little bit. But overall, I think it's definitely manageable for a lot of Canadians. And one point I want to make is that everyone has to go through what's called the mortgage qualifying rate, or the stress test. And that rate is pegged at 2% above your contract rate, or 5.25%, whichever is greater. So the last few months on the fixed side, rates have been over 4%, which means we're qualifying you on 6% plus. Most people are taking variable rate mortgages simply because it's we can still qualify 0.25. But look, rates, especially on the variable side, are not close to 5.25. So if we stress tested you and you pass the stress test, it means that, you know, those checks were in place and they're doing their job and you can still afford it. So yeah, I don't think the sky's falling.
Yeah, and I think that's a great point, is that, you know, vast majority of people have gotten a mortgage when they have been stress tested or were pre-qualified at higher rates before all the rates dip down to historic lows. So even though, you know, there's doom and gloom in the marketplace, it's really not that bad. And especially when you're making investment decisions, you know, like you said, 12 extra bucks for a 0.25% increase, that's not making or breaking any investment decision that you're doing.
100%. Yeah. And exactly. And you can speak on this probably a little bit better than I can, but a lot of these markets, we're seeing record rental rates, right? So we order what's called market rent reports. If a property is vacant, those reports are coming back a lot higher than they were before. So we have, you know, higher rental rates going on. And that extra interest that you're paying on these rental properties, investment properties. Now, obviously, I'm not a tax accountant, but I imagine you could write that off.
Yeah, absolutely. And you know, that's a great point that you're bringing up. How is rent actually used in the qualification process for mortgages?
Yeah, good question, Kyle. So we get this question a lot because if you're going into buying a rental property, chances are you already have your owner occupied your primary residence, right? So this is something you're looking to add to a portfolio, and not all banks are created equal. So banks, alternative banks, credit unions, they all have different ways of determining how much income on a rental property we can actually use. So it can vary. It can go anywhere from, I've seen 60% up to 100% rental offsets. And when I say a rental offset, it's basically we take all of the expenses associated with that property. So let's say you had, I'm going to use a house because then we don't have to include the condo fees and everything else. Let's just say it was a house or a townhouse that had no condo fees. And you just have your mortgage, you have your property taxes, and you have heat. We would include all of those as part of the carrying costs of that. And then we would offset it by anywhere from 60 to 100% with the rental income. Right. So if, let's say, for example, you're getting $2,000 of rental income, banks would look on it, and it depends on every bank's policy. Some of them are a lot more conservative, so they'll go with 60%, meaning that they're only going to use $1,200 of your rental income to offset all of your carrying costs on it, which sometimes will put you in a deficit, right? So you don't actually have a rental surplus to add on to help with sort of the debt ratios. You're actually kind of reducing. So that's why some people, when they start adding onto their portfolio, it becomes a little tricky, especially if you're working with one lender that maybe doesn't have a strong rental property program, right? And then you kind of tap out after a few properties, whereas there might be lender B who says, hey, look, we'll use 80 or 100% of your rental offset. And then all of a sudden you're in a surplus for each property, which as you start adding to that portfolio, you've actually got more of a surplus. So it really depends.
Yeah, absolutely. And that's probably one of the biggest benefits is working with a mortgage broker like yourself, because you don't have access to just one or two banks. Like, how many financial institutions do you regularly work with?
Yeah, that's a good question. Dozens, really. The nice thing is, because this is sort of my baby, Pekoe Mortgages. I've made it a point that, because I also invest too, I've noticed, and that's what really brought me into the world of brokering, was my bank couldn't help me out. Prior to sort of getting into this, I owned my own business, and it was really difficult to get approved. And when I wanted to grow a portfolio, they couldn't help me. So a broker stepped in. I was introduced by a mutual friend, and I was like, oh my goodness, this is a whole different world of like really being able to look at different options out there. So having my own brokerage, I've been able to go to a lot of smaller credit unions, right, that some people overlook, and create relationships on the branch level with them. So we have dozens. I think it's over 40 now. There's a core that we like to use, but then, you know, for the one-offs, if it's like somewhere way out somewhere where there's just a few credit unions, we'll make that relationship, and it goes a long way.
And I think that's what people don't understand as well. Everyone tends to shop for the lowest possible rate, but it's really
Mm.
about your personal situation and finding the financial institution that will play ball with you, correct? Because like I'm self-employed, not every institution loves that. So it's about finding the one that will work with your clients for your funding needs, correct?
Yeah, that's exactly it. So it's kind of like, I like to say we play matchmaker, because it's all about just trying to figure out, okay, well, what's the story here? What's really going on? Because we're all about relationship building and building trust. And I think when you're looking to grow a portfolio and build wealth, you can't just kind of say, okay, you know what? I saw that advertisement, I'm going to take the lowest rate, because that doesn't always translate into the lowest cost. There are so many other variables that are part of it. And when we kind of set someone up, we go through a discovery call, we figure out, okay, well, what is it that, what's your objective? What do you want to do with this property? What's your 5-10 year plan? And then we kind of work together on fleshing that out. Like we want a client really for life, right? And we want to grow with them, because it's exciting to see as people start building and growing a portfolio that they thought wasn't possible. They get excited, and it gets us excited too. So being able to do that is so important. And I think, yeah, matching people with the right mortgage and product to make that happen is also incredibly important. I kind of look at it like, you know, it's mortgages are one of those intangibles. You don't get to see it, feel it, smell it, but it's something that has its own purpose and pros and cons depending on what lender you go to, right? There are features and options that you might have not have considered, right? Like maybe a home warranty plan or higher prepayment privileges, the ability to port the mortgage, low penalties that are based off of contract rates instead of the posted rates. So we look at all of these things. And I kind of think about it like, we've had people that come to us, it happens all the time, and they say, hey, well, you know, what's your lowest rate? Let's talk about rate. But I think part of it is just not understanding really the questions to ask. And it's also like, I'd imagine if someone came to you as a client and said, Kyle, this is my budget and I want the most square footage. Just give me the biggest square footage. I mean, you're going to look at them and you're going to say, okay, well, that doesn't mean it's going to be the nicest house on the nicest street with the nicest appliances. Like there's a lot more involved than just square footage here. So yeah, you've got a budget, but let's figure out what you want and what's really, you know, not needed. So yeah,
100%. And I
it's
think that's a great point, is working with someone that knows those options, because I'll use myself as an example. I've gotten fixed rate mortgages in the past. I've had to break every single one of those. And I have paid tens of thousands of dollars in
yeah,
fees. Where if
yeah.
I had been, you know, it's a lesson learned. If I'd been working with a professional, I likely would have avoided that situation. So obviously you need someone on your team, and someone like Dan, professional that does this every single day. Um,
Yeah. Sorry, I was just going to say on the penalty thing, it's something that it's like the skeleton in the closet that doesn't come out until
yeah,
you don't want it to, right? So in the event, and especially with real estate portfolios, when you're growing a portfolio and you have multiple properties, I'd imagine you have clients that want to access that equity once a few years have gone by and leverage it,
absolutely. Yeah,
right?
it's one of the best ways to grow your portfolio exponentially.
Exactly. So it could actually hinder your ability to grow quicker and develop a stronger portfolio if you know you've got a massive penalty in your way. You might think, you know, have second thoughts on it. So just something to consider.
Yeah, no, that's a fantastic point. So Dan, how many mortgages can the average person get? Because I often get that question
Hmm.
from people. I have my home, but I'm not making any extra income. How do I qualify for these extra properties?
Yeah, another good question. So it's every bank has sort of their caps on how many homes, or they say doors, that you can hold within that lender. Some of them top out at 4, some go 6, few will go beyond that, and then some of them are like, you know what, we'll go up to whatever 16, but we can only have 4 or 5 being held with us exclusively. So it's just a matter, and that's the nice thing, is that every lender's got a different guideline. And it's just a matter of kind of figuring it out. Part of that, though, is making sure it can debt service. So, right, if you kind of top out, let's say the lender says you can have up to 6 units or 6 doors, but you can only really cash flow 3, then okay, well, we're going to have to look at some other options for you, right? And that's where alternative banks come in, because alternative banks allow you to use higher debt ratios for qualification purposes. They're able to look at unconventional ways of declaring income. So it's there are other options out there, but essentially every bank's got their own sort of cap on that. And then you get into sort of holdcos. So if you've got dozens of properties, like I've got one gentleman who's got about 28 doors to his name, that becomes a business at that point, where we're looking at corporations. You might be looking at commercial lending as well. So it depends, but there's a solution out there.
Yeah, no, and that's a fantastic point. I've actually got a client that has over 100 doors. So
Wow.
anything is possible. It's about working with the right partners.
You got it.
So yeah, that's really good advice. And ultimately, you talked about the secondary financial institutions, and where there tend to be more flexible. You might pay a little bit more interest, but the point is you can get a deal done so that you can buy extra properties. The extra interest that you might be paying is tax deductible anyway, so it's an expense later on. So this way, instead of having just one property, for example, you could have 2 or 3 that are earning rent, paying down the mortgage, and appreciating in value. And that's how you really grow a real estate portfolio and exponentially grow it.
Yeah, 100%. I mean, that's so important, because you kind of look at it in its totality, and you're right. Like if it's between closing and not closing on a property, I don't know about you, but I would take the additional interest rate, especially it being tax deductible, to close on the property, because now you've got the appreciation, you have the reduction on the yeah, I mean, then you get to leverage up on it in a few years as it appreciates. So yeah, good advice.
Thanks. So Dan, if someone's looking to close on a mortgage in kind of the next 6 to 12 months, do you have any advice for them or recogmendations on what to do?
Oh, that's a good question too. Man, you're coming up with all the good questions today.
These are all questions my clients are facing. For many of the pre-construction properties, especially in Calgary, they've had shorter closing periods. So many of them are facing this exact situation and facing a wall of interest rate increases and are unsure what to do.
Yeah, it's a great question. Okay, so 6 to 12 months out, the first thing you want to do is obviously get a pre-approval if you haven't done it. Have someone to review your finances to make sure there's no skeletons again in your closet, especially when it comes to your credit, right? Something may have hit your bureau that you're not aware of, and you don't want that to come up sort of on the 11th hour when you're down to the wire and you need to close. So that's really important. Figure out if you're in a spot where it's not going to be a problem to close. A lot of lenders will do up to 120, maybe 180 days for rate holds. So we can basically close 4 or 5 months into prior to sort of like, we can put the application in prior to it closing, and we can move that around a little bit. When you're getting closer to like a year out, so it's within a year, I would say just check in with your mortgage specialist or your mortgage broker and just let them know. Like I've got some clients too that are the pre-construction, and they're not closing until next February, but we kind of do these quarterly call-ins where it's like, all right, let's check it out. Let's see where you're at now. Where are rates? What is everything looking like in this sort of rising interest rate market? Now, I don't think it's going to rise forever, because the problem is if we keep rising, if the interest rates just keep going up, that could slide us into a recession, and recessions and inflation are 2 different beasts altogether. The good news is we have low unemployment. So with low unemployment rate, we can't get into what's called stagflation, which is also another bad thing. But it basically means that higher interest rates aren't going to last forever. But if you can, like if you're closing within 6 months, I'd say, yeah, get on it right away. Try to get the application ready to go and then have it submitted. Just keep in mind, if you're doing a longer closing, banks know that, hey, especially in this type of market, we're going to put a premium on that interest rate hold, because that's really what it is, right? It's an interest rate hold. So you might be facing a little higher interest rate because of that uncertainty and what's going on in the market. But I would say, at the very least, make sure someone's reviewed your credit, your income. Don't try switching jobs last minute. That's never a good
Buying
thing.
cars right before closing. Oh yeah, all
Yeah,
those
don't buy
fun
that Porsche. Wait,
stuff.
yeah, wait until after closing, and you can do that, because you're right. Anything like that could affect your application and your approval, we want to take into consideration, because earlier in our conversation, I talked about that stress test or the mortgage qualifying rate. That qualifying rate could go up, right? And
Right.
if that happens and you were approved as of today, but all of a sudden the stress test has gone up, we're going to have to revisit that. So if you're really close to it, I would say in the next 6 to 12 months, just hammer away at any sort of unsecured debt if you can, to help get your ratios a little bit better.
Yeah, and that's really good advice. And I always recommend to any of my buyers, even if they're closing 4 or 5 years from now, talk to a
Right.
mortgage broker now.
Yeah.
They can
Yeah.
look at your situation, make sure that you're not going to run into any problems, or they can identify any red flags so that you can start fixing it. Because
Yeah.
things like credit, you can repair it. Debt, you can pay down. You know, even income, you can get a second job, you can improve your income situation. So there's always things that you can do with enough time. So Dan,
100%.
you
Yeah.
do pre-approvals all the time, right? There's no fee, no cost. It's part of
No.
your product offering, right?
You got it. Yeah, it's just part of our services to make sure that, there's no surprises for the client. And then it helps us out too, because we've got the story and it creates sort of like we open an application and a file for the client. So the pre-approval process is fairly straightforward. You put an application through, kind of hold off on the credit pull at this point, but we do request, some additional documents on liability so we can be as accurate as we possibly can. If you've got sort of an Equifax consumer report, we'll take a look at that, or Borrowell, or any of those. But yeah, I mean, the pre-approval process is fairly straightforward, and then we just sort of issue a certificate. This is really important for a lot of the developers out there, because you and I both know they do request some sort of pre-qualification along with the purchase agreement. So we're happy to do that for any buyers out there.
Yeah, and it's normally because their financing is actually conditional on getting those mortgage pre-approvals from each of the buyers. So that's why they tend to make people do it. It's a huge pain in the butt, but it's very important, again, to know that you're not getting into trouble later. So again, always recommend that you do it if you're looking at pre-construction, and especially if you're looking to buy resale, because that'll be a much quicker closing, in which case you could get an interest rate lock as well.
You got it. Yeah.
So Dan, you've shared a ton of useful information. Really appreciate you coming on to talk to me today.
Problem.
I have one final question. What was the inspiration for the name Pekoe?
Wow. Okay. This one actually, so prior to getting into mortgage brokering, I actually owned a tea shop. I still own it. It's all online, but I was down in Toronto in an area called King West, and I had a retail shop. And I used to teach martial arts, and it was something that I got into. Yeah.
Awesome.
So I had this, you can check it out, herbalinfusions.ca. So I still do stuff online. We've got some folks that run it. But after that, I opened up a kombucha and juice bar with friends of mine that own a chain of yoga studios in Toronto. And we named it Pekoe because of orange pekoe. I'm not going to get into the technicalities of tea, although I did take my tea sommelier course at college. But orange pekoe refers to the highest grade of tea leaf that you can get when it comes to grading. So I went with Pekoe, and I mean, it's 5 letters, pekoe.ca. And I figured it was sort of like a little bit of tip of the hat to something that I'm passionate about as well too. So it carried over when I got into brokering, and I decided to launch my own brokerage. I was like, this is great. Let's use this. The kombucha, I think I was ahead of the time. It was kind of like, I was 5 years too early for the kombucha scene, but it was a lot of fun. And then ended up reusing that. So it goes well, because part of our tagline is we spill the tea on mortgages. So it's like, anyway, that's where Pekoe came from.
It all makes sense now.
Yeah.
Well, I'm glad to see you carrying that passion through into your other endeavors.
Awesome. Thanks, Kyle.
Thanks again, Dan. Appreciate you coming on.
No problem. Thanks for having me.
All right. Take care.
Take care.